Hello, welcome to Any Answers Answered for March 2020. This month we're going to have a look at two IHT questions. Not often we look at IHT these days, but topical at the moment as we look towards the budget. People saying there could be quite big changes as far as IHT are concerned. But for now, we have two questions to look at. Our first comes from North Star, and it is to do with business relief on AIM shares. And the question is as follows. A gentleman has been in to see me and holds approximately £1 million of shares in an AIM-listed company. He wants to leave these to his children in his will so as to make use of business relief. Presumably we're looking there at business property relief. His solicitor has suggested that there is a 3-year grace period if the AIM shares were to become relisted on the FTSE, but I cannot find reference to this anywhere. The idea being that the shares could still qualify within that period before consideration would have to be given to selling. And North Star is basically saying, ever heard of this?
Yes, it's quite well known that a holding of a portfolio of AIM shares, alternative investment market shares, can qualify for the very valuable 100% business property relief from IHT. And advice given to quite a number of high net worth individuals would include putting assets or putting some of their wealth into such an AIM portfolio to reduce significantly IHT on death. There are, of course, a number of conditions, but it's predicated on the idea that AIM does not count as a recognised stock exchange, and so the shares don't count as quoted, and unquoted trading company shares, it must be a trading company as defined, qualify for BPR. But then we have the possible problem of the AIM company being very successful and eventually becoming listed. Here it says relisted on the London Stock Exchange. Of course, at that point, the portfolio would immediately lose the entitlement to business property relief. However, and this is what's behind, I think, the question, there is, under Section 107 of the Inheritance Tax Act, the possibility of replacing business property with other business property and still getting the BPR. Now, the relevant of the replacement provisions, and this will get us to this question about a 3 years period, is that in order for any asset to qualify for BPR at the date of a transfer, typically on death, the asset must have been owned for at least 2 years. So it's no good having a deathbed investment in an AIM portfolio. You would need to have held the shares for at least 2 years before death for them to qualify on death.
Okay.
So what happens if you have £1 million in these AIM shares that qualify at the moment and you've held them for several years, but then the company is listed on the London Stock Exchange? Well, if you were to sell the shares and acquire other business property, possibly other AIM shares, then if at the date of death the replacement property has not been owned for 2 years, although prima facie you would not then qualify for BPR because you haven't met the 2-year condition, Section 107 could come to your help, because what we have to do is look at the previous 5 years. And as long as during the 5 years before the transfer on your death, let's say, you had held the original and the replacement property between them for at least 2 years, you'd be okay.
And it's still worth pointing out, I always think in these situations, having the AIM portfolio in the first place for at least 2 years is a very good inheritance tax piece of advice.
Look up Hotel Chocolate.
We will do so immediately. Our second question this month comes from, well, there's actually two versions of the same sort of area. One is from Tax Angel, one is from Penelope Pitstop, who has asked for our help. Penelope has probably asked for our help. Downsizing relief, residential nil rate band is the question. And fundamentally with residential nil rate band, we have a rule that relates to where you've sold the original property, but there is a downsizing that has happened beforehand. And the calculation of this is really quite complicated. And so, Tim, perhaps we just take one of those sets of numbers and I'll let you work your way through them.
Well, the first of the two queries that we're looking at was posted by Tax Angel on 25th of Feb this year. And the other one was posted, as you say, by Penelope Pitstop on the 4th of September last year. And what's interesting is that neither of these has attracted any comments whatsoever. Each of them looks at a complexity in the downsizing rules that are part of the residential nil rate band. The rules then become more complicated when we look at what happens if an individual sells a residential property and either does not buy another residential property, perhaps because they move into a nursing or care home or retirement home, or they do downsize and buy a smaller property. And then on death, the residential property in the estate will either be nothing or a lower amount. And what the relief conditions allow is that we can look at the value of the original property and take that into account. And to take a simple case, if you sell your property and move into a home, then, or rented accommodation, as long as assets in your estate on death pass to your direct descendants, then you can trace those assets back to the proceeds of the residential property and apply the residential nil rate band to that. But this is where it then gets complicated, and perhaps this is why neither of those two postings have been commented on. And I would recommend that you look at the HMRC guidance on this, because it does have a number of useful numerical examples, and there's a link in one of the postings, I think the Penelope Pitstop one, to the revenue guidance. And what the legislation does is seek to uplift the value of the original residential property that's sold by reference to the uplift in the residential nil rate band figures from 100 to 125, 150, 175. And that's why, as in I think the Penelope Pitstop posting, it's possible for the residential nil rate band applicable to derived assets to exceed the value or sales proceeds of the residence that was sold 3 or 4 years before death. And it's because of that uplift formula that the legislation applies. So it's the same answer to each case. Yes, each of the posters is correct in their analysis, but you need to look at that revenue guidance to see numerical examples of it. There's also quite an interesting planning point that emerges, I think, in the Penelope Pitstop posting, which is that because of the vagaries of the calculation, it may be advantageous to accelerate the sale of a residence preparatory to going into a retirement home, let's say, into an earlier rather than a later tax year. So if you're looking at selling a residence at the moment, then selling it before April 20 would be better than selling it after the end of this tax year.
But the answer to the two questioners is that yes, you are right. They are right that it is possible to end up with more than you bargained for, based purely on the fact of this uplifting calculation on downsizing. Seems strange that we have an uplifting on downsizing. But anyway, join us again next month when we will look at 2 more questions from the pages of Any Answers. But for this episode, bye-bye.